Hello, and welcome to our video on stocks for beginners. If you've always wanted to understand what stocks are, how they work, and how to start investing in the stock market, you're in the right place. Over the next 90 minutes, we will cover everything you need to know to take your first steps in the fascinating world of investments. In this video, you'll learn what stocks are and how they work, how the stock market operates and the role stocks play in it, how to choose and buy your first stocks, basic strategies for investing in stocks, what you need to know about risks and how to manage your portfolio. Let's start from the basics so that you have a complete understanding. Stick with us, and let's discover how you can begin investing in a smart and secure way. Narrator. First, let's understand what stocks are and why they are one of the most popular investments in the financial market. Simply put, stocks are shares of a company's capital. When you buy stocks from a company, you are buying a small piece of it. This means that as a shareholder, you become one of the owners of the company, although in a small proportion. How do stocks work? When a company decides to grow or needs capital to expand its business, it may issue stocks on the market. This is done through a process called an initial public offering, IPO. At this point, the company puts its stocks up for sale to the public, and anyone can buy these stocks. As a shareholder, you can make money in two ways. Appreciation of the stock value. If the stock price rises over time, you can sell your stocks for a higher price and make a profit. Dividends. Some companies distribute a portion of their profits to shareholders, known as dividends. This is a way to share the profits with those who invested in the company. Why do companies issue stocks? Companies issue stocks as a way to raise money. Instead of taking out a loan from a bank, they sell parts of their ownership to investors. This allows them to fund new expansions, new projects, and other types of investments without taking on debt. Practical example. Imagine you buy 100 stocks of a company offering its shares on the stock market. If, after a year, the price of each stock rises from $10 to $15, you can sell your 100 stocks for $1,500, making a profit of $500. Additionally, if that company pays dividends, you'll also receive a portion of the profits based on the number of shares you own. Now that you know what stocks are, it's important to understand how the stock market works, the place where stocks are bought and sold. The stock market is an organized marketplace where investors buy and sell stocks of listed companies. There are many stock markets around the world, with the most famous being the New York Stock Exchange, NYSE, but in Brazil, the most important one is B3, the Brazilian Stock Exchange. How are stocks traded? When you decide to buy or sell stocks, you do so through a brokerage firm. The brokerage is the institution that intermediates the transaction between you and the stock market. When you decide to buy a stock, you place a buy order through your brokerage's platform. The brokerage then sends that order to the stock market, where it is recorded. So, when there is a seller willing to sell at the price you are offering, the transaction takes place. Transactions occur in real time, and stock prices can vary constantly depending on supply and demand. This means stock prices can rise or fall rapidly based on various factors such as the company's financial health, the country's economic situation, and the political climate. The role of institutional and individual investors. There are two main types of investors in the stock market: institutional and individual investors. Institutional investors are large investors such as pension funds, mutual funds, and banks, who buy and sell large amounts of stocks. Individual investors are people like you and me who buy stocks for their own portfolios. Practical example. Let's say you want to buy stocks from Company X. You access your brokerage platform, type in the stock's code, the ticker symbol, and place a buy order. If there is a seller willing to sell the stock at the price you've offered, the transaction is completed. The stock price can change instantly due to supply and demand, which makes the stock market exciting but also volatile. Now that you understand how stocks and the stock market work, let's talk about how you can start investing in stocks. The first step is to choose a brokerage firm, which is the institution that will allow you to buy and sell stocks. Nowadays, there are many online brokerages that offer easy-to-use trading platforms. Steps to start investing in stocks. Choose your brokerage, research available options and choose a brokerage that offers the best conditions for you, such as low fees and an intuitive platform. Open your account. Open an account with your chosen brokerage and transfer the money you want to invest. This process is usually quick and simple. Research companies. Before buying stocks of any company, it's important to study it. Try to understand the sector it operates in, its financial health, and growth prospects. Diversify your portfolio. A good practice is to diversify your investments by buying stocks from different companies or sectors. This helps reduce the risk of losses if one stock performs poorly. Buy your first stocks. Once you've done your research, it's time to buy your first stocks. You can do this by accessing your brokerage platform, searching for the stocks you want, and placing a buy order. Practical example. If you're interested in buying stocks from a company that is growing in the technology sector, you can start with a small amount and, as you feel more comfortable, increase your investments. While investing in stocks can be a profitable way to build wealth, it also involves risks. The value of stocks can fall, and you could lose money. It's important to understand these risks and how to manage them. Risks of investing in stocks. Volatility. The price of stocks can rise and fall quickly, which can cause uncertainty and even financial losses. Market risk. The economy and political climate of a country can affect the value of a company's stocks, regardless of its performance. Company risk. If the company you invested in doesn't perform well financially or faces difficulties, the stock price can drop drastically. How to manage risks. Diversify your portfolio. As mentioned before, diversifying your investments in different stocks can help reduce the risk of losses. Invest for the long term. If you buy stocks in solid companies and have patience, the value of the stocks tends to rise over time. Be prepared for volatility. Don't panic with daily fluctuations. Have a long-term plan and stick to it. Practical example. Let's say you bought stocks from a company that is going through a tough period. Even if the stock price falls, if you believe in the company's potential, you may choose to hold on to your stocks and wait for the recovery. Now that you know what stocks are, how they work, and how to start investing, you are more prepared to take your first steps in the stock market. Remember, investing in stocks is a long-term journey, and knowledge and patience are your greatest allies. If you enjoyed this video and want to learn more about investing and finance, don't forget to subscribe to the channel, like, and share this content with friends and family. Our goal here is to help you make informed financial decisions and build a more secure and prosperous future. Thank you for watching, and we'll see you in the next video.